Hey guys, what's up? It's the Impeccable Investor here, and as Warren Buffett says, price is what you pay, value is what you get. In this video series, I have been showing you how to value a company the right way, going over ratios like the P to E ratio, the debt to equity ratio, and so much more. Today in this video, we're going to pull all those ratios together and show you how to analyze a company and see if it's going to be a buy. If you want to see what company that is and what website we're using to research, please stay tuned. Now guys, if you haven't already, please hit that like button. Please hit that subscribe button and turn on those alerts. I come out with videos every single week for you, the average investor. Alright guys, if you haven't already, the link below will send you to my free investing course that covers everything you'll ever want to know. Alright guys, we're going to get into the video now, so please stay tuned. Hey guys, welcome into the video here. So this is research.tradeking.com. Please use the web link below in the description of this video, because if you try to go to it yourself, it's going to ask you to log in. You don't need to log in, just use this direct link. Alright guys, you can type in any symbol up here and it will show you the stock that you typed in. So for instance, we covered the price to earnings ratio in one of the first videos. So if you can see here, today we are analyzing Visa Incorporated. What a great stock. The reason why I wanted to cover this is because I believe it's a great buy, and I want to show you how the fundamentals of the ratios support this buy. So the price to earnings ratio, it's on the lower side of the industry range. That's an amazing thing, right? Because that shows you how much earnings you are receiving for the price you are paying. So we have to pay $33.81 to receive $1 of earnings. Now, it could be $161, so we are doing a lot better than the industry. Alright, the next thing that we also hinted at was the short interest as a percent float. So the short interest as a percent float, as previously mentioned, is the number of shares in the company that want the company to decrease in value. So seeing that it's under 2%, that means that's very good. The lower the better. And again, you can't really take this industry average as high because it has no values for the industry. Next, we talked about the net profit margin. Seeing here that it's a 51.53% profit margin shows us that it's in the upper portion of the range. So not only is it in the upper portion of the range, but it's also making money. That shows that when it makes a sale, it actually gets to keep money and reuse that in order to reinvest it or to give back to shareholders as dividends or whatever else they choose to do with that money. Net profit margin should be positive, and it's in the upper portion of that range, so that makes this a great buy. The next thing we talked about was the debt to equity ratio. This shows the company's leveraged position. As discussed in depth in that video, all these videos will be linked below so that you can go back to it. But it shows the leverage. It shows how much debt they're using to make money. Now remember, for a long term, you want the company to have as little debt as possible to function, right? Because if you go through a bear market, all the companies will be lacking on their sales, will be doing low on figures, so they don't want to have that much debt, so they don't have to pay off all that debt. So here is that debt to equity ratio, and it shows us that it's in the lower portion of the range at 47.7. Therefore, they are able to effectively use debt to make more money, but they're not able to over leverage themselves in the industry. We also looked at return on assets. So return on assets is the amount of return, how much sales, how much money they can make with the assets that they have, whether that be their inventory, their cash, their plants and property, and whatever else that they have as an asset. If you can see here, it's one of the highest in the industry range with a 61.12%. This is meaning that it has an effective use of its money. The return on assets of 61.12 shows that it can effectively use the money it has with a low debt to equity ratio, showing that it can actually function in the long term. Also here, something that we did not mention but is great to look at is the current dividend yield. It says that it's offering a 0.55% dividend yield. Now again, that is low in the industry, but compared to how well this company functions, a dividend yield is just going to help you gain money to either use as income or to reinvest in the stock in order to make more money over time. So what we're seeing here is, using all these ratios together, we can tell that the price to earnings shows you that it is a good value in the industry. It's a good value buy. Looking at the float, it shows that we don't have much fear of the stock dropping massively because that's not what a majority of the people want. And also looking here at net profit margin, we have a 51.53% margin. So if they make $100, they get to keep $51.53 of that. Now magnitude that on the sales of $22.3 billion. They get to keep a little bit over half of that because of how they roll. That means that they are in the best industry range. That's what we want. And the debt to equity ratio is low as well. That's what we want. Return to equity is higher. Now let's go into looking at another thing in this industry. Now I wouldn't say that PayPal is exactly in this industry, but it is a close comparison that we're going to look at here. So the price to earning is also low. The percent short is lower actually, which is good. The net profit margin is 15.33%. So this is a lot lower. So that means that they have a lot of overhead costs, a lot of things that they have to worry about that lowers their profit margin, which could mean that it's not as effective or they have too much going on. Their sales are even lower. That means that their sales are lower and the net profit margin is lower. They're not making as much money. The debt to equity ratio here is lower, so that's great to see. We definitely want a lower debt to equity ratio since it has that lower net profit margin. That means they're not making as much money, so we don't want them to be paying off a lot of debt. So the return on assets is a 7.26. That is a measly small amount, and it's a very sad amount in my opinion. It has no dividend, which is also another knock on it, and that is just an example of how you can use the ratios to compare different companies to show that actually Visa is the best buy here. All right, guys, I hope that made sense. And if it did, please hit that like up button, hit that thumbs up button. What am I saying? Like the video, and please hit subscribe because I have videos like this coming out every single week. Now, if you haven't already, please follow me on Instagram because I have a lot going on there as well. All right, guys, see you in the next video where I'm going to discuss the complete A to Z video. It's probably going to be long over how to invest in the stock market from getting a broker to then doing everything else. All right, guys, thank you so much. See you in the next video.